Hi everybody. The next part of the program, we're going to be covering the carryback of a universal life policy. One of the things that's important when you're doing a carryback and you're going over their existing policy is that you make sure the client really understands the way that their current program works. What that does is going to motivate them to make the change. If they don't really understand it, if they don't see how detrimental it is to them, then they're not going to want to make the change. So you're going to see me go into a lot of detail. It may seem like a lot of detail, but it's better to have a lot of detail up front. Make sure they understand it. That will also help your persistency dramatically. I promise you that. You're not going to have people charging back. You're not going to have an issue with that. The better the client understands what they currently own and why they need to change. Hi guys, good to see you again. I've come back. I had a chance to look at your VUL, your variable universal life policy, and I've got some really interesting things to share with you. And I've got a proposal for you that's going to knock your socks off. I mean, it's really going to be exciting for you to see what we're able to do and how much we're able to help you. So, but I want to make sure that you really understand how your current program works, and you understand why you need to make a change, okay? So what I'm going to do is I'm going to go over that in a little detail, and I doubt that when your agent sold this to you initially, he went into detail about how this worked, did he?
No.
Not really.
Not really, okay.
Your brother sold it to us.
Right,
So.
okay. Well, that's not, that's not a problem. I mean, maybe he didn't even understand how it worked in detail, okay? So I have a question for you. Since your brother sold to you, a lot of times when a relative was the agent previously, people have a little bit of concern about making a change because it might affect their relationship or not. I don't know if are you feeling that at all?
Kind of.
Yeah.
I mean, if you could do something better, I'm okay with it.
You're okay?
I think she might have.
Right. Well, the point is this, okay? If I'm assuming your brother loves you and cares about you and wants the best for you, and I'm sure he probably sold you the very best thing he possibly could, right? I mean, because if there was something better, he would have done that. Right. Would you agree with that?
Yes.
Yeah, I would hope
All right, so that if I'm going to share with you this information and what I'm going to show you is better than what he has, he shouldn't have a problem with it because he would have sold you that initially in the first place anyways if he could have, right?
Right.
Assuming he really had your best interest at heart.
Right.
Yeah.
So I don't see that he should have any problem with you making a change as long as it's improving upon what you currently have. Would you agree with that?
Yes.
Yeah. Okay, great. Well, fantastic. So if we show that this is really significantly better, we're not going to have a problem making the change tonight?
No.
Well, yeah, I mean, we'll see as far as how it all turns out.
No, I understand that. But if it's better and you can see it and it's graphically night and day difference, is there going to be any challenge in taking care of this tonight?
Not for me.
Okay. Well, I mean,
Yeah, only if it's better. If it's not better, then of course you leave it as it is, right?
Yeah, because we've had this for a while. Then.
Yeah, but if it is better, then you'd obviously want to make a change and improve your situation, wouldn't you?
Yes.
Yeah, as long as we don't lose out on any money that we, because we've invested quite a bit.
Sure. Okay. Great. All right. That's no problem.
Okay.
Well, first of all, it's your insurance company's Western Reserve Life Insurance of Ohio, and what it says right here, I just want you to point this out. It says I underlined it. The amount of the death benefit proceeds will increase or decrease depending on the investment experience of the subaccounts. In other words, what that means, based on your investment, if your investment goes up, the insurance benefit could increase. If the investment of your investment part of the savings part goes down, then your death benefit could decrease. How do you feel about that?
Is that the coverage?
Yes.
Well, that's not good.
Okay. Well, by the way, the thing that's binding between you and the company is what's in this policy. That's the binding thing. So whatever's in here is what's in here. That's what it is. Okay.
Yeah, he never told us that.
Yeah. Well, you may not have even realized that. So you have a flexible premium variable life insurance policy. I'm just going to kind of real quickly go over. Denise, you got $250,000 of coverage, right? And at $308, or actually it's $358 is the initial premium. And then there's one other policy as well, which you have $217,000 worth of coverage. And then there's a surrender charge. And for the first 4 years, okay, you can see that. What it says right here is this $1,764 per $1,000 of specified amount. So what you do is you multiply that 250 times 1764. That's $4,410. That is the surrender charge. In other words, if you were to surrender your policy in the first few years, this part right here you lose.
But he told us it was only going to be $17, so that's why we didn't think it was a big deal.
No. It's not $17. It's 17. See, it's per 1,000 of specified amount. The specified amount is 250,000. So you need to multiply 250 times that, and that's what the surrender charge is.
No wonder you
Okay,
don't want us to
and it's the
cancel it.
same. And exactly, it's the same for for 5 years, and then it starts to decrease. It goes to 39, 33, 30, and you can see all the way. It goes to 0 over here. Okay,
Oh, wow.
in the 16th
Okay.
year. All right, so there's so this I wrote here. This is the amount of your cash value they keep if you cancel your policy. This is deducted because it represents the commission paid to your brother.
Wow.
So that
You're
money,
making a lot of money
that
on it.
money's already gone no matter what you do.
Okay.
Keep it, you replace it, you already lost that. There's no way of recouping that money. It's gone, and it's paid out in commissions. Does that make sense? So
Yeah.
that's your brother got a portion of that. That's how he got paid.
Wow.
Okay.
All right?
What, you so anxious to give us one of these, huh?
Yeah. Do you see that?
Yeah.
Yeah.
I just, and I mean, I don't know your brother, but I just want you to point out the facts. The facts are the facts.
Okay.
You with me? Okay?
Okay.
You're not
Okay.
feeling too good right now?
No.
There's
All
more.
right. Don't worry, we got a solution, so it's going to turn out fantastic. Don't worry about it. And then we have $217,000 of coverage on that's your policy portion, and then the monthly cost is $3,700 for that. That's the deduction, and that, by the way, comes out of this original amount, this $358. That's part of that. Okay. So there's
That's every month that comes out, huh?
That's every month. So it's $250 of coverage on you and $217 on
Okay.
you. All right. But one of the things I want you to be aware of, when these kinds of policies are sold, people really don't know how they work. Remember, it involves, it has some savings, which he told you about,
Yeah.
right? And then it also has life insurance protection.
Right.
Okay. The life insurance protection, there's a cost for that. All right. And the way life insurance is priced, it's per thousand. You know how like gas is per gallon?
Right.
Right now it's $3 plus, right,
Yeah.
per gallon. Well, life insurance is priced per $1,000 of protection of coverage.
Okay.
In your case, it's 250 units, right?
Okay.
250,000. So what you do, you look at right here. It tells you what the cost every year is, 38, 39 every year, all right? And what you do is you multiply 1,000 times 250, which is the actual amount of coverage, and that's annual. It's an annual rate. So the first year, the cost of this protection that you bought this policy was $995. Then it goes to 1,000, then 11, and you can see it goes up every year.
Wow.
I just figured out exactly year to year how much it costs, and you can see it goes up every year. Okay, and what that in simplistic terms, that this kind of insurance inside the cash value policy is annual renewable term insurance. So each year it renews each year, and each year the price gets bumped up a little bit more. The reason for that is because you're a little older, and obviously your mortality is a little more probable. So as you get older, the chance of you dying increases, so the risk increases, so they raise the price of your insurance.
But, we've had it for a few years now, and it's never gone up.
It hasn't gone up because you're overpaying quite a bit. So if the first year was $995 and you're paying $300 and some a month, which is what's that annually?
Over
That's
$3,000.
yeah, $3,000. You're overpaying to the tune of a couple $1,000s the first year. So it's going up inside the policy, but you're not seeing that. You're not experiencing that. Does that make sense?
Yeah.
Yes.
Okay, but at some point, you're paying $3,000 a year, right? A little over that, almost $4,000 a year. It takes a while, a few years, several years. It doesn't happen until like about this year right here. So it's like in the 20th year, it starts becoming, the premium becomes more than you're actually paying. And then you have the differences being accumulated in the account. So then what happens, once the policy has some cash built up in it, and after 20 years, it's a pretty good amount of money. Then, even though the cost of insurance goes up, they start taking money out of the savings portion to cover the increasing cost.
And this is supposed to be a retirement.
Yeah. Okay. So, but the bottom line is this: is it the total 20-year premium total for this insurance protection you have? Is the actual cost of the insurance is $43,000, and 25 years it's $67,000, and if you kept it for 30 years, the actual cost of insurance would be $106,000. That's what you'd be spending
Just for the insurance
just for the
cost.
insurance only.
Okay.
Okay, so even though it starts out like it looks like it's low, it goes up, and then yours is a little bit less. It's 20-year total is 26, 45, and 69. Okay, so you really got to add those two together. That's what the total cost is. All right, and I'm going to explain why that's important in a little bit. Okay. And I want to just show you a few things in the policy that you probably weren't aware of, and most people, I do this all the time. Almost nobody ever understands how their policies work, because what happens when people buy life insurance policies, or homeowners insurance policies or health insurance policies. What we do is we get the policy from the agent and we go, oh, okay, I got an insurance policy. And then we open a drawer and we put it in, or we have a file for
Exactly what we
it,
do.
and you never see it and you don't look at it again until you need it, right?
Right,
You got a flood, your car, get a car wreck,
Right.
health problem, or someone dies. That's a problem with that, is if you don't really understand how it works, then you may be purchasing something that's not the best solution for you, right? So I want you to see a few things. The death benefit, which is the $250,000 to $217,000, it says right here that the proceed amount payable by us under this policy is the death benefit minus monthly deductions, any outstanding policy loans. In other words, let's say that over time you've accumulated $50,000 in your policy of cash, in your savings part that she talked to you about. If you were to withdraw that, borrow that out, okay, number one, you'd have to pay interest at about a 6% interest rate. But if you died after you borrowed money out, they would deduct that from the, they're going to deduct that from the, they're going to deduct any outstanding policy loans from the death benefit. So his is minus the loan, all right? So the death benefit to your family would be $200,000. So if you borrow money out, took your savings out of the policy, and then you died, they're going to deduct that savings part from the death benefit. They're going to keep that part.
It's not good.
Yeah.
Does it make sense?
Doesn't sound like it's our money.
So how do you feel about them deducting your savings from the death benefit?
I don't like
Does,
it.
don't
does that
think-
seem
That's not
right to you?
No,
No,
it's not
not
right.
at all.
Yeah, it isn't, okay. The other thing too is that you have a thing called a grace period. If the amount due, in other words, your payments due, right? If the amount due is not proceed with us within the grace period, which is 61 days, under the policy, any riders will terminate without value at the end of the grace period. So in other words, whatever you have, it'll just terminate. The policy will lapse. Okay. So the problem with that, how does that happen? Well, if you go back to the cost of insurance, when the cost of insurance starts getting to be $6,000 or $8,000 a year or $10,000 a year, and you're only paying $4,000, that money's going to be taken out of your savings. And when that
Right.
that money's depleted, there's no more money in there, then the policy has a potential for the policy to lapse. And then now you have no coverage, you have no savings, you have nothing. Do you see? Does that sound good?
No, not
Okay.
at all.
All right. Well, don't feel bad, because I've done this for years, and nobody ever understands how this works until I sit down and explain it to them. Okay. So the other thing is, on the investment part of it, it says right here that on that investment objective, they reserve the right to change the investment objective of a subaccount. So at any time they want to, they can change that on you without advising you or talking to you about it or whatever. They have an opportunity to do that anytime they want. They have it written into the contract. And then right here, if you need money from your account, if you did want to borrow money, it says we further reserve the right to defer payment of any amounts from the fixed account for no longer than 6 months. So, and plus you have to provide in writing that you want to withdraw it. And then once they receive the written response, they have the right to defer, which means not give it to you, up to 6 months. So you might need it for emergency. Let's say, if something happens, your kids, need braces, or whatever. I mean, there's a lot of different things you might need that money for.
You got to plan ahead for those.
Yeah, so it's a real challenge. You can't get to it quickly. It's not easily accessible because they control it. So how do you guys feel about them having control over your money?
No, I don't like that.
Nope.
Not
Don't
good?
like 'em.
Okay.
Yeah.
So again, the surrender, I mentioned this earlier, but the net surrender value, the cash value as of such date minus outstanding loans, they deduct that. And then on withdrawals, it says, if you want to withdraw, it says cash withdrawals may be made any time after the first policy year. And while this policy enforced, only one withdrawal is allowed during a policy year. So you can, if you need money, you can only borrow it once. You better be sure that's when you wanted it, right?
Wow.
And then the amount of withdrawal may be limited to less than $500 and to no more than 10% of the net surrender value. So you've got to be at least $500 and no more than 10% of the total amount that you can, all right? So you can't take out everything, right?
It's too many.
Yeah, so the request for withdrawal must be by written notice. Again, you got to write to them, which means crazy. Doesn't that sound crazy? And then they charge you a processing fee of 2% of the amount withdrawn. So how do you feel at the restrictions regarding your money? They have a lot of restrictions, don't they?
Yeah,
Huh?
I don't like that.
Yeah, not very good, right? Okay. For us, remember, let's go back to what you were spending, right? I'm going to do that real quickly so you can remember, right? You're spending $358 a month right now for your current program. So what I did for the same $250 and $217 with us, it's $117 a month.
Okay.
Okay, quite a bit different, right?
Yes.
Yeah.
That's a big difference. So let's take a look at what does that mean, all right? This is our proposal. You got 250, 217. Currently, you're spending 358 a month, 4296 a year. Savings and retirement, I don't know. Nothing was in here. I'm sure there's some, but I don't see it anywhere. And then the coverage after this would be with us now. Our proposal is 250, same coverage, 1,100 a month, 1,300 a year versus 4,200. And that would represent a $247 a month savings, almost $3,000 a year that you would be saving by buying our term policy, okay? And so one of the good things about this, the thing that makes this really attractive and why it makes sense for you to make a change tonight, okay, is that you have total and complete control over your savings. Like this savings part, we're going to invest it in an investment account, a mutual fund, separate from the life insurance company, completely separate, that you guys are going to have total control over.
So we don't have to borrow it?
No borrowing, no paying interest,
Doesn't affect your life.
doesn't affect your life insurance protection, no cost to withdraw, you control it.
So we could just pull it out. We don't have to write a letter or anything.
No, you just you can either you can do it over the phone, or you can do it and write it if you wanted to, right? So so plus withdrawals and savings don't impact, so it doesn't affect your death benefit, which you mentioned. And then the potential savings, I'm going to show you how we're going to do that, is anywhere from $1,250 at retirement, and potential retirement income is $100,000. So what we propose is, because we've saved that money, right? That $2,900 a year is the savings. What we propose is investing that. So this is a illustration, a hypothetical illustration, investing that over that same period of time. So what we found by investing that, first month's 247, then it goes to 2,900. That's the difference. Investing that every year, you can see your account value is 233, then it's 29. It goes up, right? After 20 years, you're going to have at the rate of return that this particular investment account had during that time period was 13.26%. Your account value after 20 years would have been $246,000.
Wow.
Okay, so you remember you got 250 on you. So initially, I mean, you're basically at the end of that 20-year period, you're self-insured. You have enough cash set aside, which equals the amount of death benefit you have. Also, what works here is that if you were to die at that point, your family would get the $250,000 plus the $246, a total of almost $500,000. Wow. That would be the total death benefit versus the way that works.
Okay.
Do you see the difference there?
Yes.
Is that a big difference or a little difference?
A huge difference.
It's a huge difference, okay? Plus you get to control that. And if you take this to age 67, your account's $1,251,000. And then at the end of the policy, right, you're current at age 73, it's $2 million, all right?
Wow.
So let's say now, one of the things that's important is you guys want to retire, right?
Yeah.
Yes.
So by saving that money, this is going to provide retirement income. So let's say now you're ready to retire. You have that $1.2 million. Remember that? We got that right here. So, that period of time, you're 67, you're ready to retire, you got $1.2 million. Let's say we invest that now. This is showing, starting with $1,251,000 and withdrawing every year 8% of the account value for retirement, a flat 8%. The first year would be $100,000. The next year, $104,000. It goes down a little bit here. The market dropped probably a little bit. Then it's $105,000, $120,000. You can see 8% every year. Down, 10 years or so, it's $133,000. That's what you're withdrawing to retire on, right? So from all the way to age 87, if you were alive that long, hopefully you probably will be, because you're not going to have as much stress. You're going to be in great shape financially, right? Yeah. So what's going to happen at age 87, you would have had withdrawn out of this account $3,141,000, which is, it's a pretty decent amount of money every year, right? Mm-hmm. At the end, you're keeping up with inflation as well, right? It's kind of a cost of living increase. You can see that. Okay. All right. So you withdraw that, and then the account value, even after withdrawing $3 million, would be $2,591,000. Remember, you started with $1.2 million. You withdraw $3 million. The account's worth $2,591,000. That's $1,339,000 increase in initial value after the withdrawal of $3.1 million. Do you see that? Does that make sense?
Wow.
Yeah.
Look at that.
Huh? Is that wild or what?
That is.
Huh?
So
awesome.
I've withdrawn.
You've withdrawn $3 million.
And
it's worth $2.5
than what we started
because what's happening is you're getting a better rate of return. It's putting off more cash than you're actually withdrawing, and so the account value grows.
Okay.
Do you see how that's far superior to what you're currently doing?
And you have investments that have done that?
Absolutely. This is actually, I'm going to show you all at Van Kampen Comstock Fund, Van Kampen Income and Equity. I'm going to give you prospectuses. I'm going to show you how that all works.
All right.
Okay?
Yeah.
Does that sound
You can
good?
help me do that.
Now I want you to remember now, right, because we talked, you're going to do the business with us, right? I want you to see how this works. If you were to sit down with people and you were to show them what I just showed you, can you see how anybody with any common sense whatsoever would see how graphically clear it is for them to go ahead and make a change?
Yeah, well, we referred her
gonna
brother
say.
to like 4 other people.
other
Yeah.
people.
So what we're going to have to do is we're going to have to go see those people because they probably have the same thing,
Yeah.
and then we're going to be able to replace that easily with no problem whatsoever.
Okay.
Okay, and we're going to start building you a business that way. By the way, of all the insurance sold in the country, cash value is sold about 80+% of the time. So the majority of people that do have life insurance, unfortunately today a lot of people don't have it, but the ones that do, almost all of them have some version of what you had.
Wow.
Okay, so, and the people are just like you, very intelligent people, hardworking people, conscientious people, but if you don't know all the facts, you can't make a good decision, right? And so what happened, they didn't have all the facts, so they made the decision based on what the representative shared with them. If the rep would have shared all this, if your brother would have shared all this other stuff with you that I showed you that's actually in the
No, he
policy,
never went over that.
would you have bought it?
No way.
No, of course not. Nobody would. So all we do is educate people. We show people actually how it works, and then we show them an alternative way that's vastly superior to what they're currently doing, and we help them make the change.
Okay.
You see that?
Yeah.
All right, great. Well, let's go ahead and get this started then right now. All right? All right, guys, that's how you carry back a cash value policy. Those are the kinds of things you point out. Point out the cost of insurance, what it actually costs. Get them to understand that within a cash value policy, it's all annual renewable term going up every year, and that at some point what's going to happen is the cost of the insurance is going to surpass what they're actually paying in, and then that's going to cannibalize the savings part of their policy. And then it's going to, at some point it's going to go defunct if they don't, raise the amount they're investing, or if they have poor investment performance. Any way you shape it, having to borrow your money, having to lose your savings when you die, which basically they keep the savings. I mean, there's so many things. They have the right to defer giving you that money for up to 6 months. Cash value life insurance, under no circumstances, ever makes sense. Ever. Positively ever. I don't care if you're making, $50,000 a year or $5 million a year. There's no time at any point when any form of cash value makes any sense whatsoever. When you peel back the onion and you really show the difference between buying term and investing the difference, especially in a mutual fund, especially in a qualified account like an individual retirement account or a 401k, it always makes more sense to do that. And we're going to get you to the point where you understand this so clearly, you're going to be able to explain it to the client so he or she really understands it, and they find it very, very easy to make the transition from what they currently have to buying term insurance and investing the difference in mutual funds with us at Primerica.